Hello, everybody. Welcome to this week's edition of Northwest Quadrant Wealth Management E-News. Thanks for joining us. So the stock market has made a round trip. We know we saw a sell-off when the war in Iran started, and the market has recovered all of those losses and is right essentially where it was when the war started. So, like we said, this is mostly about a duration situation with the war in Iran and the oil shock. The longer it goes, the bigger the problem it becomes. But so far, it hasn't really had a material impact on the U.S. economy. Obviously, there's different industries that it's affecting. If you're a farmer and the cost of diesel, all of those sort of things are quite impactful. But it really hasn't affected demand in a really meaningful way here in the United States just yet. But that's why everybody, it's a broken record, talks about duration and how long this thing lasts, because if oil stays where it is and really ultimately diesel and jet fuel stay as high as they are, that will ultimately have an impact on GDP growth and demand here in the United States and around the world. So we should all hope for a resolution to the situation in Iran sooner rather than later. But the good news is, for everybody that stayed invested, you're back to where you were before the war started, and really ultimately asset allocation is working really well. Small cap stocks are doing well, international still doing well. Value stocks in our dividend portfolio are doing really well. So we're really optimistic about where our portfolio is allocated right now. And the reality is, markets really, really want to go up, as evidenced by, we don't have any resolution in Iran, but markets are back to where they were when the war started. So the big risk ultimately for the Federal Reserve is we have a stagflationary environment, right, where prices are higher, meaning inflation is higher, and that would make them want to be raising interest rates, but we also have slower growth because demand destruction is happening because of the higher prices, and that's that stagflationary environment, which is very hard for a central bank to deal with. So again, it all comes back to the duration of the war in Iran and how long energy prices stay elevated. We're certainly in a better position here in the United States than the rest of the world, but over time, if energy prices stay high, it's certainly going to impact what the consumer is doing here in the United States. Thankfully, we have all of you baby boomers that are flush with cash, and it's yet to impact you, and Josh can sort of talk about that.
Expectations were really high coming into this earnings season. We were looking at roughly 12.5% earnings growth, which would be good for 6 quarters of double-digit growth. And you look at that, and earnings season, of course, started off with an absolute bang this week. The banks collectively had their best quarter in profits ever, minting over $25 billion in net income. But you look at earnings expectations generally being revised upward during the stock sell-off, and it sort of tells you that we have room for stock prices to continue to run. Most of the growth is, of course, coming from the big technology stocks, and that structural trend of 80 million baby boomers with flush with cash and little to no debt is, of course, what is driving earnings expectations, along with $750 billion in AI-related capex this year, and of course, some really strong incentives for companies to spend money that were embedded in that one big, beautiful bill that are now effective as of the tax year of 2026. Oil prices weren't high enough for longer in the first quarter to really impact the energy front. But overall, it's looking like an extraordinarily strong earnings season is off to a good start, and we have really hopeful expectations as the big technology names report next week.
One of the things that Josh and I are getting via email from clients and on phone calls is certainty around what you think is going to happen as it relates to the markets because of the situation in Iran. And I would just urge all of you to forget about how you think about the situation in Iran, whether you agree with the war or not, as it relates to your portfolio, because essentially this is an energy shock to the global economy, and we have plenty of examples of these in the past where maybe markets sold off in the short term but did well over the long term, and that's what we need to get you focused on. Stop putting your personal opinion about what's going on in Iran and combining that with what you think you should do with certainty as it relates to your money, because those are oftentimes bad decisions. And so try to separate the two. It's fine if you disagree with the war in Iran. Just don't let it cloud your judgment around how you think about your investment portfolio, because they're very different. So as always, if you have questions about your situation or your account, give us a call at the office, 800 743-0988, or email either one of us, Josh or Tyler, at northwestquadrantwealth.com. We'll see you back here in a couple weeks.